Hi, welcome back. It's Jordan and Brian. And what we're going to do is we've spent time on the first two parts of our wealth report. And what we want to do is focus on that third part of that wealth report, which is our historical performance, our rates of return. And so we're going to jump right into it with Brian, and we're going to spend some time on that.
Great. Thanks, Jordan. Appreciate it. And I think the historical performances, like you mentioned, is really important. And we want to talk first about the three different risks during retirement, just to kind of recap for Richard and Grace Turner. And we talked about the longevity risk, the fact that you may live too long. We talked about the tax risk, the fact that tax rates may go up in the future, and the costs associated with that with the various investments that you choose. And now what we're going to talk about is stock market volatility, which is the third risk to look out for during retirement. A couple key points we want to talk about with stock market volatility is, when you're nearing retirement or even in retirement, it's really important, like Kevin's parents he talked about, to avoid those losses when possible. Now, a lot of financial advisors will talk about diversifying against market risks. You buy a basket of mutual funds and, with various types of asset classes in hopes that you can diversify enough to minimize your losses. But what we want to do is not diversify against risk. We want to completely eliminate risk. The fact that we won't have those 2008s, 2009s where we may lose 40%.
Yeah, and it's basically, you can see a sequence here that we're talking about. And when we're looking at our distribution, we've said it over and over again, is we're not so much worried about those high rates of returns. That's not a huge concern. We're more concerned about mitigating those losses and protecting our account value.
Now, for Richard and Grace Turner, again, they're maybe 20 years away from retirement, but it's still important to implement these types of plans today, and they'll be happy, they'll thank us for it when they get to retirement.
Yeah.
So what I want to do is kind of look over a backcasting report that we put together for Richard and Grace, and really what this is we looked at every single trading day the stock market was open since March 2nd, 1989. So it turns out that a typical scenario, which basically means that 80% of the policies return this percent or better, believe it or not, was 7.48%, about 7.5%. One thing I should mention is these are 15-year periods, so basically an average return of about 7.5% over 15 years. Now, a conservative scenario, which means 90% of the policies performed at this percent or better, was 7.18%. So still above the 7% return, very, very promising. Now, the worst case scenario, this basically means that 100% of the policies performed at this percent or better, 6.61%. Still a very favorable return, especially considering over this time frame, we've had two of the worst market collapses, the liquidity crisis recently, the last 6 years or so, as well as the tech bubble burst. We avoided all those losses and still captured a significant portions of the gains.
Yeah, and this is a great slide, and it's a good point to make sure that you guys are still aware. This is using our wealth report for the Turners, and this is looking at that 15-year time period. Now, the nice thing is that wealth report, we customize it. So if you, the client, have a 30-year time horizon, unlike the Turners, then we can look at it from that point of view, and these illustrated rates are going to be different. So this is based off of their 15-year look back, but it's also really important to understand that this is multiple 15-year look backs, right? Can you just kind of explain that? I want to make sure that they understand that it's not just taking one snapshot from March 2nd, 1989, 15 years from now, and this is what the number is.
Yeah, great point. Yeah, this looks at every single trading day the stock market is open. So whether you bought it at March 2nd, 1989 or March 3rd, this looks at every single possible time you could have considered buying one of these vehicles. The nice thing about that is there's thousands and thousands of data points, and it's not just looking at one point in time to the next. I think the other nice thing you mentioned is that this is customizable. We have all the data points stored, so we can look at 10-year look-backs, 15-year look-backs, 20-year look-backs, etc.
Yeah, so these numbers, they're the average of the average is what we're looking at. We're not looking at one average sequence of return. We're looking at all of them put together and then averaging them out.
I would argue those are great returns, 6.5% to 7.5%.
Yeah.
But what we want to do is look at what are the maximum returns and what are the averages as well. Believe it or not, the maximum return, which basically is the highest 15-year look back, was 11.61%. So, I mean, if you're able to achieve a double-digit return for 15 years, that's very, very promising.
Yeah, and we're looking, again, just at the returns. We're not factoring in those other two risks that we talked about previous with the taxation, which we've minimized that. So, I mean, what would you think in a qualified account after taxes we'd have to earn to net that 11.6?
That's a great question. And if you're, in a decent tax rate like most of us are, you probably have to earn at least 15-16% in a taxable environment to net the 11.5% that we're earning tax-free. Now, the average return is 8.97%. So about a 9% return we're able to achieve on an average basis. Now, these are really high returns, and we don't know what the next 15, 20, or 30 years will look back. We don't have a crystal ball. So what we prefer to do here is, rather than showing these high returns to Richard and Grace and our clients, is we strongly believe to underpromise and overdeliver. And what that basically means is we would use a more conservative scenario, like a 6.5 to 7.5, around 7% on average, so we're providing projections that are more likely to occur.
Yeah, so kind of that previous slide, we want to show with an 80% confidence and higher, this is what you can expect in your contract. And that's something that when you're working with your advisor that you should be aware of, and that we're running them at that amount and challenge them to ask those questions why.
What I want to do next is kind of compare this wealth vehicle, our maximum funded IUL, versus the stock market in general. And I think the more comparisons we have, the better. Some of our best financial decisions, like we mentioned, are using a basis of comparison. So if we compare all those data points of the wealth vehicle that we're using versus the S&P 500, believe it or not, we were able to beat out the S&P 500 86% of the time. Now, the important thing about that is not only we're able to beat it out a good majority of the time, is we're also able to not diversify, but eliminate all the market losses and still capture roughly 80% of the market returns. So what we did is we didn't look at necessarily just the average returns, but if we put $100,000 in the S&P 500 versus a properly funded life insurance policy, we're able to start off, here at the same March 2nd, 1989, and you can see we kept pace with the stock market. Roughly, we could achieve the majority of the returns, or a good portion of the returns, during the bull 90s. But you can see when the tech bubble burst, over that 2.5 years, people lost 30-40% of their money, whereas with our life insurance policy, we stayed roughly level. We not diversified against the market losses, we eliminated it. When the market came roaring back, we captured a good majority of the returns in our life insurance policy, but what happened again, stock market cyclical, and that's what the stock market does. It goes up and down. Think of it as you're going up a staircase or an escalator with a yo-yo. Long-term trend has always been up,
right, but
you're going to have those dips in the market. The nice thing is that we avoided those losses, and the last 5-6 years, the market rebounded. We captured roughly 80% of those returns as well. What's going to happen from here if that trend is going to continue to go up? No one knows, but I would guess at some point it will go down. That's what the market does. It's cyclical, it goes up and down. And our point is, for Richard and Grace Turner, we want to avoid those big market losses, not only now, but into retirement.
Yeah, this is a great piece, and this is something that you guys should really focus on, because when we're looking at the Turners, when we get to the point of the Turners getting to pre-retirement, so maybe 10 years down the road, 15 years down the road, they're getting close to taking that distribution. Like Kevin's parents, if they were ready to take their distribution during this time period, now that really hurts them. That really, really hurts their total income model for distribution. And this is really good to understand. We've talked about historicals and averages, but these are actual numbers.
Yep.
And numbers are more powerful than our average rates of return.
Yep. You don't pay your groceries in percentages, you pay your groceries in dollars. I think that's a good point. So just to summarize what we did for Richard and Grace Turner, we focused on 3 major risks during retirement. The longevity risk, living too long; taxes, the fact that taxes are likely to go up; and lastly, what we just talked about today, stock market volatility. So to kind of wrap it up, really what's important is not only did this work for Richard and Grace Turner, but we can actually help you at home with these as well and customize wealth reports for your unique situation. First step is to click down below and you can see where you can request to meet with a financial advisor who will talk about your unique situation and see if these ideas can work for you just like they did for Richard and Grace.
Yeah, it's nice. It's nice to be able to go back and forth and work with your advisor to say, okay, I want to see a 15-year period or I want to see a 20-year period like we talked about before. So this is great. You know, that wealth report is at your disposal. I highly recommend using it. One of the things that we want to talk about next is when we showed that graph where if we were in the market, how we had that downturn, but maybe that index account, it goes horizontal, how do we do that? And so we want to spend some time, we've shown you comparisons, but how does that index strategy work inside our life insurance? How do we earn that interest, but then also protect us from the losses? And so what we're going to be doing in the next videos is explaining that, going more in depth so that you understand how we move horizontal and up versus being in the market and having to recover from those losses. So thank you very much. We'll see you on the next video.